Welcome to TalkTickers. We know you're busy, but understanding company performance is, well, it's essential.
It really is.
And that's what we do. We cut through the noise. Today, we're diving into the latest TC Energy earnings call.
Yeah, we'll pull out the core insights, what you really need to know about where they stand and where they might be heading.
Okay, so let's start with the big picture. How did the first quarter of 2025 look for them?
Pretty strong, actually. Operationally, very solid. They highlighted a 5-year low in safety incidents, which is, always good to see.
Definitely. Safety first.
Absolutely. And financially, their model seems, resilient, holding up despite market ups and downs. They've also pointed to several drivers they expect to fuel growth going forward.
And they stuck to their outlook for the year.
They did. Reaffirmed the 2025 outlook. They sound pretty confident it'll boost their financial strength and flexibility.
Okay. Any major project milestones hit?
Yes, quite a bit of movement. The big one, perhaps, is the Southeast Gateway project. It's complete.
Southeast Gateway. That's the Mexico pipeline, right? Completed and under budget, I heard.
That's the one. And yes, 13% below the original budget estimate. Pretty significant saving.
Wow, okay.
Yeah.
That suggests some solid project management.
It does. And crucially, it's fully contracted long-term right through to 2055 with CFE, Mexico's state utility. So decades of predictable revenue there.
That's huge. Is it flowing gas yet?
Almost. They're just waiting on a sort of routine regulatory nod from Mexico's Energy Commission, the CNE, for interruptible service. They expect that by the end of May.
Interruptible service, so capacity that can be paused if needed.
Exactly. Standard procedure. Once that approval comes through, invoicing starts, usually after about, say, 30 days.
Got it. And what if there's a delay? Does that hurt the economics?
Well, they have something called a total adjustment mechanism built in. It basically protects the project's overall value, the NPV, regardless of the exact start date.
Smart.
Yeah.
So the value is preserved.
Right. And it fits nicely into Mexico's bigger energy plan, Plan Mexico 2030. So strategic alignment there, too.
Okay, makes sense. What else is moving on the project front? Anything in the U.S.?
Yes, definitely. The Northwoods project got the green light. That's a $0.9 billion expansion of their ANR pipeline system.
ANR, that's U.S. Midwest, right?
Okay.
What's driving that expansion?
Primarily data centers. Huge energy demand growth there. This expansion is designed to serve new gas-fired power generation needed for those centers, plus other economic development in the region. It's about 0.4 BCF per day capacity.
Data centers again. It's a recurring theme. What makes Northwoods attractive for TC?
Well, a couple of things. It's underpinned by a 20-year take-or-pay contract.
Take-or-pay, so guaranteed revenue even if the capacity isn't fully used.
Exactly. And it's with an investment-grade utility, which lowers the risk. Plus, the estimated EBITDA multiple is around 6 times.
6 times. So payback in roughly 6 years of earnings. That sounds pretty good.
It's very attractive, yeah. They framed it as a classic low-risk, in-corridor growth opportunity, leveraging assets they already have. Service should start in 2029.
Okay, so clearly capitalizing on that data center boom. Are they seeing this demand pop up elsewhere in their network?
Oh, yeah. They mentioned a, quote, significant inflow of service requests related to data centers in the U.S. right at the front of the meter.
In Canada.
In Canada, they're exploring options too, talking to producers, talking to developers, potentially looking at a more full-service approach there. They mentioned Alberta specifically has a queue of about 12 gigawatts of potential data center load.
12 gigawatts. That's massive.
It is, and they could leverage their big NGTL footprint there, which already handles like 80% of Western Canadian gas production.
But they aren't planning to actually build and run power plants themselves, are they? I thought I saw something about that.
No, that's right. They were clear on that. They're looking at gas solutions, maybe some power solutions, but not becoming an IPP, an independent power producer. They'll be selective, These projects have to compete for capital.
Makes sense. Okay, speaking of capital, what's the overall spending picture looking like?
For this year, 2025, net capex is forecast between $5.5 and $6 billion.
Okay.
But interestingly, they expect to put about $8.5 billion worth of assets into service this year, and that's actually tracking about 15% below budget right now.
Below budget. So finding efficiencies there too.
Seems like it. And they've been busy adding to the backlog about $4 billion in new long-term contracted projects announced in the last 6 months alone.
Which includes Northwoods, presumably.
Includes Northwoods, yes. And also sanctioning the next phase of the Bruce Power refurbishment, the Unified Major Component Replacement, or MCR. That's a $1.1 billion investment.
Bruce Power, that nuclear facility, a huge part of their portfolio. How's that whole upgrade program going?
Progressing well, it seems. Availability was 87% in Q1, and they expect it to hit the low 90s for the full year.
That's a good target.
Yeah, and importantly, the previous unit refurbishment, Unit 6 MCR, finished on time and on budget. That builds confidence for the next one. The plan now is 2 units per year for the next 5 years.
Wow, ambitious pace.
It is. Plus, they have this Project 2030 at Bruce, aiming to significantly boost its peak output.
Okay, so lots of activity. Let's circle back to the financials. You said they reaffirmed the 2025 outlook.
Yep. Comparable EBITDA target is $10.7 to $10.9 billion. That's a 7% to 9% bump over 2024 if they hit it.
And longer term.
The 2027 target is still $11.7 to $11.9 billion. So looking at a sort of 5% to 7% compound annual growth rate over that 3-year period.
And what gives them confidence in hitting those numbers?
A huge part is the contract structure. 97% of their EBITDA comes from rate-regulated assets or those take-or-pay contracts we talked about. Very predictable revenue streams.
Right. That provides a strong baseline.
Exactly. And, they also pointed to their dividend track record, 25 straight years of increases.
A quarter century, yeah. That definitely signals stability to investors.
Yeah.
How are they funding all this growth, though? The CapEx, the dividend?
Good question. The updated funding plan calls for about $31 billion over the next 3 years.
$31 billion, okay.
But the vast majority, around $24 billion, they expect to cover with internally generated cash flow.
Okay, so mostly self-funding. What about the rest? Selling assets, issuing stock.
The remaining $7 billion they expect to get from capital markets debt, presumably but explicitly without issuing new equity. So no shareholder dilution planned.
That's significant. Avoiding equity issuance.
Yeah, and they're also aiming for about $1.3 billion in capital reductions over 26 and 27 through optimization efforts, squeezing out efficiencies.
Okay, so the funding plan seems solid. Did they flag any major headwinds or, potential bumps in the road?
Well, the regulatory situation in Canada came up, specifically around permitting for big infrastructure projects.
Yes. Permitting timelines can be a challenge.
Exactly. They stressed the need for a clearer, more predictable framework, especially with the new government there. Getting timely approvals is key.
Makes sense. What about LNG Canada Phase 2? That's a big potential project for their system.
They sounded optimistic about the potential, but they were careful to say the final investment decision, the FID, is up to LNG Canada, not them. That decision's expected maybe around 2026.
So still ways off.
Yeah. And TC's view is that real progress on Canadian LNG overall needs clear political will and regulations with enforceable timelines. Permitting reform is a broader issue they see as potentially unlocking more activity benefiting their NGTL system in the main line.
Right. Regulatory certainty is crucial for these massive long-term investments. What about Mexico? Any shifts in strategy there?
The main focus in Mexico right now is just getting the current projects like Southeast Gateway, flowing gas, and generating cash. Simple as that.
Okay. Still aiming for Mexico to be a certain percentage of their business.
Yeah, the goal is still eventually hitting around 10% of consolidated EBITDA for Mexico.
Yeah.
If they ever decide to sell assets down there, they'll be patient, look for fair value. It's more about portfolio optimization than, say, needing to deleverage quickly.
And their counterparty risk there. It's all CFE, right? Not PMIX.
Correct. 100% CFE, the national power utility, which is investment grade. No direct commercial deals with PMAX. CFE's got its own growth plan focused on electricity, upgrading plants, separate from PMAX.
Got it. One more thing, partnerships. Are they thinking differently about bringing in partners on projects?
Seems like it. They hinted at maybe leaning more towards partnerships rather than just selling assets to help fund growth and manage leverage, especially for the really big projects potentially coming later this decade.
Why the shift?
It lets them keep some upsides, some embedded optionality in those projects rather than selling them off completely. And specifically in Canada, they mentioned partnerships with Indigenous communities are a really key factor for any new greenfield projects.
Right. That's increasingly important. Okay. So summing it up, solid results, strong focus on executing these contracted projects like Southeast Gateway and Northwoods, leveraging data center demand, navigating Canadian regulation, and maybe using partnerships more strategically going forward.
That's a pretty good summary, yeah. Low risk, contracted growth seems to be the core theme. Resilience and predictability.
All right, let's shift gears. Time for our This Is Not Financial Advice segment. What unconventional idea did this earnings call spark?
Okay, so thinking about that huge push for data center power, especially with TC Energy building out gas infrastructure in the U.S. Midwest, Here's a speculative thought.
Lay it on us.
Consider looking at companies that specialize in advanced microgrids, specifically ones integrating on-site natural gas generation with battery storage, tailored for data centers in that Midwest region.
Interesting. So not TC Energy, but companies enabling power solutions at the data centers TC might supply gas to.
Exactly. It's a leveraged play. If TC's projects help accelerate that Midwest data center boom, and those centers increasingly look for super reliable, maybe grid-independent power, these specialized microgrid providers could see, potentially explosive growth.
A sort of picks and shovels play on the data center power demand.
Kind of, yeah. But focused on that specific niche gas-powered microgrids for Midwest data centers. It's definitely high risk, high speculation, though. Depends on data center, build-out pace, tech adoption, the whole regional energy mix. Lots of ifs.
Definitely requires digging deeper. And as always, everyone, do your own thorough research before making any investment moves. That's crucial.
Absolutely. Okay, so that wraps up our deep dive into the TC Energy call. We've hit the key results, the big projects, the strategy points. Hopefully gives you a clearer picture of what's going on there.
We hope it's been insightful. Join us next time on TalkTickers, where we'll break down another key earnings call to bring you the essential information.